Big investors are moving out of US bonds. Not in panic, but with purpose. Why? Because America's debt market is no longer the fortress it once was. The world's largest bond market, once a symbol of safety, is now raising serious concerns. Concerns about debt. Concerns about deficits. And concerns about political unpredictability. At the center of it all, Donald Trump's trade war and his sweeping new tax bill. The House of Representatives just passed what Trump calls his big, beautiful tax bill. But behind the branding is a stark reality, a massive increase in public debt. That's rattling investors. In the past, US Treasuries were the go-to safe haven. No matter the crisis, money flowed into American bonds. But not anymore. During the fallout from Trump's tariff blitz, US debt didn't act like a refuge. It swung wildly, and that scared people. Vincent Mortier, chief investment officer at Amundi, Europe's biggest asset manager, put it bluntly: the US is no longer the ultimate and only perceived safe haven. He called it the home of extreme fiscal indiscipline. And it's not just Amundi. At JP Morgan, Bob Michel says their clients feel exposed. Overweight on dollar assets. Nervous about what's next. They're watching tariffs go up. Debt levels climb. And confidence slip away. So what are they doing? They're diversifying. They're looking to Europe, Japan, Australia. Markets that once played second fiddle are suddenly back in style. Why? Because they're offering yield and calm. Lindsay Rossner at Goldman Sachs says it clearly: the dollar is the story. She calls it the world's most liquid and lawful market, but warns there's weakness now. Weakness with staying power. The dollar has dropped 8% this year alone. And long-term US bonds are getting hammered. The 30-year Treasury yield has surged above 5%, the highest since late 2023. That's not normal. It's a warning. Rossner says the lesson is simple: there's power in diversification outside the US. Even PIMCO, the global bond giant, is urging caution. Its leadership told the Financial Times that now is the time to look beyond US shores. Because the risks are real and rising. Henry McVeigh from KKR calls it a turning point. Trump's so-called Liberation Day, when he launched global tariffs, has had ripple effects across portfolios. Sovereign wealth funds, pension plans, family offices. All are now rethinking their US exposure. All are asking the same question: how do we reduce our overweight to US assets? And it's not just sentiment. Policy is driving this. Trump's 2017 tax cuts, already controversial, are set to be extended. That means higher deficits, more borrowing, and more supply of US debt. Amundi's Mortier says the US will likely run a permanent deficit of 6 to 7% of GDP. That's massive by global standards. And with more debt hitting the market, buyers will start demanding higher yields. Can America find enough buyers? Yes, but only if it pays more. And that raises borrowing costs even further. That's the cycle investors are trying to escape. Which brings us back to Europe. Once seen as fragile, bond markets in countries like Italy and Spain are now gaining investor trust. JP Morgan's Michel says the new core is developing there. And as confidence in the US slips, others are stepping up. This doesn't mean the US is finished. The dollar will remain the world's reserve currency for now. Treasuries will still anchor portfolios. But the blind trust? It's fading. Investors aren't abandoning America. They're hedging against it. Because today's markets demand agility. And tomorrow's risks may not wait. So the message is clear: the era of US bond supremacy is under pressure. And the smart money? It's already on the move.